Hello, everyone. Welcome to our discussion of Chapter 15, the last chapter of the textbook we'll be covering. We're going to dig into corporations. So this first video will be about what is referred to as C corporations or corporations in general, and then we'll get into specifics about C corporations. And then the second video will be about S corporations, which are actually probably more common when you're doing tax returns and things like that in a regular setting. So first of all, corporations are legal entities formed under the cause of state. What that means is that you don't have a corporation until you have established and followed the guidelines for the particular state you want to operate in. They have to be formed that way. Paperwork has to be filed. There has to be an articles of incorporation. There has to be a fee paid. It has to be registered with the state. Okay, so you can't just by accident have a corporation. Technically, under a partnership, you can act like a partnership even if you don't have an official agreement or anything like that. That's not true for a corporation. You have to have some type of formal paperwork establishing the corporation. And that goes for any corporation. Okay, they can use the cash basis of accounting just like individuals can, as long as their gross receipts aren't over 25 million. At that point, you have to use the accrual basis of accounting for your tax return if you're a corporation. So they can also, and this again, we're talking about C corporations. C refers to the chapter of the tax code where the requirements are listed. These corporations can choose any fiscal year. So usually they do that in their first year of operation. They can choose the calendar year, which is what most of them do. January through December makes it real easy with W-2s, with all the other things that are done on a calendar year. But you do not have to. You can do fiscal year. You can do any literally any year. It has to be the end of a month though, or beginning of the month. So you can go November 1st through October 31st, unless you want to do a 53 week year, and that's more complicated than we want to talk about probably. But we file everything on a form 1120. We'll notice later that the S corporations file an 1120S. There is no such thing as 1120C. It's just an 1120 for a C corporation. They're due on the fourth month, April 15th. If it's a calendar year, you get a 6-month extension. So there's they're April 15th, same as individuals who are on a calendar year. Okay, if you use a June 30th year end, you can file the third month after. You get it's due earlier, but you get a 7-month extension. So a little weird, a tweak in the law there. So when we form, the first thing we want to talk about is how do we deal with forming the corporation. Remember, corporations are legally separate and are responsible for their taxes. These C corporations separate from their shareholders. Okay, so you form the corporation by the shareholders putting money or some other assets into the corporation. In return, the corporation gives them stock. Okay, and typically what we want to have happen when that happens is we don't want any tax implications. We don't want any gain or loss to the corporation or to the to the shareholders when they form it. Otherwise, it's a real pain. It's because everybody's going to have something to pay. Figure out how much tax you got to pay. So the law says, Internal Revenue Code says, on corporate formation, no gain is recognized if the shareholders put in, and then after they control 80% or more of the corporation. So essentially, if 3 people all put in $50,000, okay, to a corporation, and they own 100% of the stock, 33% each, then there's no gain or loss. Okay, if they, instead of putting $50,000 in cash, they put in assets that had appreciated in value. Say they all put in a piece of land. that when they bought it, it cost them $20,000, but now is worth $50,000. So when they put that in, technically, they're getting $50,000 worth of stock back, right? But they don't have a gain because between the three of them, they control 80%. And that's what we want to have happen. What this means is with a corporation, at the beginning, it's pretty easy to set this up to have 80% control. But when somebody else, a fourth party, 2 or 3, 4 or 5 years down the road, wants to get into the corporation, wants to contribute land that has been appreciated, it's going to be very difficult because that person is not going to come in and take over and own 80%. They're not going to control that. And they can't be considered part of the original group. So that makes it a little harder for a C corporation to admit new owners. Now, if they want to put in cash in, that's never an issue. There's never gain or loss on contributing cash. Okay. Now, even if you do an asset and you follow the 80% rule and things, you could still have situations where you could recognize gain if you contribute an asset subject to a liability and the corporation takes over the liability, right? Because you gave the asset and they take over the liability, and the liability is greater than your basis in that asset. So you bought the asset for $40,000. Okay, it's now up to $80,000. You have refinanced it and you have a loan against it for $60,000. If you contribute that to the corporation, and the corporation is now going to take over the liability of $60,000, your basis is only $40,000. So you've got a $20,000 gain. If you put in other property other than cash, okay, that has gain or loss involved in it, okay, or you receive other property. So if you get cash back from the corporation, you could have boot. If you get back a car, so you get put in the land and they give you a car back, again, you could have gain, especially on that car. If the car was an antique and had increased in value, there could be gain that needed to be recognized on that car prior to dealing with it in terms of the transfer. So what happens after this over in the normal course of the situation? Okay, the basis of the contributed property of the corporation. What is the corporation going to use for depreciating that asset? Okay, equal to the basis of the hands of the shareholder. And then if there's any gain because of some of those weird examples, then you got to add that to it. Okay, so if I put in land that I had cost me $40,000, even though it's worth now $100,000, okay, to the corporation, the corporation's basis in that land is $40,000, what it was originally in the hands of the shareholder. And then the basis of the stock to the shareholder, okay, is the same as the property they put in. So if I put in my land that I paid $40,000 for is now worth $100,000, my stock is got a basis of $40,000. Okay, and that's going to basically stay the same. It doesn't get adjusted in a C corporation like it does when you talked about with partnerships last week. Okay, so it's going to stay $40,000 until you sell those shares. All right, unless you change ownership, buy more or whatever. Okay, or sell it, part of it off or something like that. It's going to stay that same. Okay, so easy example that kind of we've been using: contributed land with a fair value of $100,000, basis of $40,000, newly formed corporation, and is going to now own 90%. Basis is $40,000. There's no gain or loss, okay, because he's now in control of the corporation. Now, it doesn't have to be just one person. It could be a group of people as they all put it in together and control the corporation. They all get the same treatment, okay? But remember, somebody later on is not going to enjoy that same treatment. All right. How do you know how much the taxable income and what your tax liability is if you're a C corporation? Because remember, a C corporation does not pass through the income to the shareholders like a partnership, and as like we'll see with S corporations, they are responsible for the tax themselves. Okay? We don't really have AGI. We just calculate taxable income. We do have some kind of order of things and some special items that are not part of anything we've considered earlier in terms of individual. But generally, we learned about trade and business expenses. You have income from a corporation, just like if you were a small business Schedule C or a partnership. You have income, and then you have expenses that are legitimate expenses, the same definition as you have for anybody else, the expenses. All right, but you don't have this kind of middle calculation called AGI per se. You will not see AGI anywhere on the 1120 tax return. So some things that are different for a corporation versus an individual. Okay, capital gains and losses are netted together. That's not real new. Okay, net capital losses are not permitted. Remember, individuals can offset capital losses against capital gains, and then they can deduct up to $3,000. Okay. Against regular income. Not true for a corporation. They get no $3,000, no capital losses at all. All they can do with capital losses, carry it back 3 years and then forward 5 years. Okay? So, moral of the story is, C corporation, you don't want to generate capital gains and losses. That's not a good way to buy and sell things that are going to generate capital gains and losses. Okay? Net capital gains are included in income just like everything else. There is no special capital gains rate for C corporations. There's no such thing as that. Okay? So capital gains are the same as any other income. So no special on the capital gain side, and no losses on if things go poorly. So really not a situation where you want to have capital gains or losses in this entity. Okay, charitable contribution. Remember, the individuals have some limits on how much they can make charitable contributions based on their AGI. Corporations have a much, much lower threshold. Only 10% of their taxable income. You have to figure out that before charitable contributions, before the dividends received deduction, and before any carrybacks, carry forwards. Okay, carrybacks. Sorry, not carry forwards. This was 25% for a short while during the pandemic, so you may see things about that, but it is now back for 2022 at 10%. And the excess can only be carried forward for 5 years. That's the same as individuals, okay, who can only carry back 5. Okay, the contribution amount for ordinary income property. If you give inventory, if a food store gives away food to someplace, they can only deduct the cost to them, not the value of that food, right? Okay. So there's that also in the issue there. So that's your restrictions on charitable contributions for corporations. Not the best place to give contributions through either. Okay. Corporations also have, and this is a deduction that we've never talked about, that has nothing to do with individuals per se, and therefore, this is the only entity that it applies to is C corporations, and that's a dividend received deduction. And it is simply a deduction, okay, against the dividends you receive from another corporation. So if Corporation A receives dividends from Corporation B, and both are C corporations, both in the United States, then report the income that you received as dividends. You put that as regular income, but then you get a special deduction that recognizes that part of that shouldn't be taxed. So if you have less than 20% ownership in that other corporation, you get a dividend received deduction of 50%. So half of it is a deduction. So therefore, the net result is you pay tax on half of it. If you own between 20 and 80%, you get a deduction for 65%. So the net impact is that you pay tax on 35%. And if you own over 80% of that other corporation, then you get 100% dividend received deduction. Okay, meaning none of the dividends you receive. You still report it. You report it as income. You take a deduction for the whole amount, and that offsets each other, and you get zero of the dividends included in your actual taxable income. This may be limited if your income is low, meaning that it can't be greater than the same percentage of your income. Okay, so the dividends are a significant part of your income. You could have a restriction that may keep it from being the full amount of the dividend. Okay, so another thing that came up, kind of different, you might say, although it also applies to other entities, but not to individuals, is organizational expenses, startup expenses can be amortized and deducted over 180 months. Okay, you have to choose that. Okay, some could be, and many of them could be, immediately deductible. Okay, and our tax rate, and it makes it really easy to calculate what the tax liability is for a C corporation, is 21% of their taxable income. There's no graduated tax rate anymore. There's no some part at 10%, some part at 15% like individuals have. Everything's 21%. They make $1 of income, they pay 21 cents of tax on that. If they make $1 million of income, they pay $210,000 of tax on that. It's real easy to figure that out. You don't have to look it up in the table or any of that kind of thing. Okay? Corporations, just like individuals, are to put in taxes. Now, of course, there's nobody to withhold it. There's no withholding, but you have to pay it in over the course of the year. It's due on the 15th of the 4th, 6th, 9th, and 12th month of the fiscal year, okay, or the calendar year. You have to pay in 100% of the tax due from the last year, okay, or 100% of what it's going to end up being. If you don't pay enough in before those dates come by, you will have some penalties and on that. That's basically interest, because the government looks at it as you didn't pay it on time. We're loaning you the money, so you have to pay interest on it. All right, so this net operating loss. Now, first of all, with a C corporation, if they lose money, meaning their expenses are greater than their income, that does not pass through to the shareholders like it would with a S corporation or a partnership. So is there any benefit? Does a corporation get to do anything? I mean, shareholders still kind of suffer a loss, meaning their C corporation ownership looks a lot worse because the company lost money. So any impact at all? And the answer is sort of, okay? Prior to 2017, okay, the rule was if you had an NOL, meaning you had more expenses than income, you could take the expenses from the current year and carry them back and offset income from 2 years backwards and then forward for 20 years. Okay? And you can choose to only go forward and skip the going back if you make that election. Okay, NOLs generated 2018, 2019, 2020. This was all in response to the pandemic. They changed the rules retrospectively. Okay, they said if you had a loss in 2018, 2019, and 2020, it can be carried back 5 years. So they expanded how far it could go back, and carry forward, okay, indefinitely, but you can only offset 100% of your taxable income in 2020 and 80% in 2021 forward. Okay? NOLs in 2021 and later, so 2022, if the NOL actually happens in 2022, cannot be carried back at all. It only goes forward and can only offset 80%. So you can't wipe out all of your income for 2023, let's say. Let's say you have a loss in 2022. You can't go backwards. You lost $10,000. You carry that forward, okay, and you can use that $10,000 of extra expenses, if you will, in 2023, but only to the extent of 80% of your taxable income in 2023. So you can't wipe out all of it. You can wipe out most of it. 80% is most, but you cannot. You have to keep carrying it forward to another year. So, corporation reported taxable income of $390,000 before charitable contributions or any of the other adjustments. Okay, but they made charitable contributions of $100,000. Okay, their only deduction, they only are permitted a $39,000 deduction, 10%. And the rest can be carried forward to next year, where you would also be limited to 10% and 10%. You can go forward 5 years, okay, and then it goes away. All right, so the concept now is we deal with what happens when money is paid from the corporation to the shareholders, okay? Corporations have what's called earnings and profits, similar to what we learned in accounting about retained earnings. It's the accumulated profits they've ever made, but it's based on the tax law, not on accounting rules. So there are some differences. If they distribute cash or property, it doesn't matter, okay, which one it is, they are dividends to the shareholders. That means they're taxable to the shareholders, but not deductible by the corporation. All right, so that shareholders going, if they're an individual, reports it as any other dividends on the 1040, okay, going to pay, it'll be qualified dividends, most likely, so they're taxed at a lower rate, but they're still taxed. Okay, and there's no deduction by the corporation. It doesn't reduce the amount of tax that the corporation has to pay. Okay. If you have more, distribute more than is included, what you have in earnings and profits. And earnings and profits includes the year that you make the distribution, the income for that year plus any income for previous years. If you distribute more than you have as earnings and profits, okay, then it is not taxable to the shareholder. The amount they receive in addition, up and above the amount of their dividends is a return of their basis. So how much they originally paid for the stock is reduced. Okay, so let's say that I have earnings and profits of $50,000. Okay, and I make a distribution of $60,000 to my sole shareholder. So my sole shareholder gets $50,000 of dividends. The other $10,000, I have to go back to when I paid for my stock. Let's say I paid for my stock $5,000. That means they're repaying me $5,000 back for what I bought the stock for. So my basis is reduced, but I don't pay tax on that $5,000. So that's $50,000 was a dividend, $5,000 was return of the stock money I put in, and then anything more than that is a capital gain. And that's what that second bullet point is, capital gain. Okay, so in this case, my $60,000 with $50,000 dividend equal to the earnings and profits, $5,000 return of capital, not taxable, $5,000 capital gain. Okay. If the corporation distributes property, let's say that instead of giving the shareholder cash, they give them a piece of land. The piece of land has gone up in value since the corporation has owned it. So the corporation bought it for $40,000. It's now worth $80,000. Okay. Before they do anything, the corporation has to pretend that it was sold for 80,000. So they actually recognize a gain of the 40,000 to bring it up to market value. And then if they distribute that land, it's the same as an $80,000 distribution. And you then look at whether you have enough earnings and profits, whether it's return of capital, return and the capital gain based on the fair value of the land, just like you would a cash distribution. If we do a liquidating distribution, meaning we're basically going out of business, wrapping up, okay, we record all assets and liabilities at fair market value, record gains and losses, okay, and then we distribute that all to the shareholders, okay, and shareholder gets capital gain or loss equal to the fair market value of what they receive compared to their original stock basis, which is most likely what they originally paid for it in a C Corp. Okay, corporation has earnings and profits of 10,000 and makes a cash distribution to a sole shareholder amount of 11. How much is the dividend? 10,000, right? Can't have any dividends more than the earnings and profits. The other 1,000 would reduce the shareholder's basis. All right. This next section is about what some special schedules that can be done in part of the 1120. Okay, Schedule L, M1, M2 are on page 5. If you're small enough, you don't have to report this, okay? But Schedule L is a beginning-ending balance sheet, okay, that basically shows what the assets, liabilities, equity of the corporation were over the course of the year so that the IRS can kind of see if they're reporting all of the things properly, okay? M1 reconciliation from what says on your financial statements you provide for the bank or your internally or whatever to your what is shown on the tax return. It's a reconciliation. All right, and it sets forth any differences between what you reported in terms of tax, permanent or temporary tax differences. If you have had intermediate accounting, you know we spent a whole chapter talking about tax accounting and the differences and how those affect the financial statements. This is how it affects the actual tax return side. Some are added to book income, some things that you have to make changes that would be shown on your regular income statement versus the tax return, and some are negative, meaning they make taxable income go down, okay, because they're not included. And then there's even more detail in M3 if your total assets are 10 million or more. Okay, some other issues: if a common parent owns at least 80% of one or more corporation, they can file together one return for the whole group, pretending like they're one company instead of multiple companies, even though they're legally separate. And brother-sister groups, okay, if you have a few people who own 2 or more corporations, okay, this group owns 80%, and they all are owned by the same people, we can kind of merge them and file as one, okay, and disclose that to the IRS. They wrote in this limitation that has to do with the business income. Notice this: you can't deduct essentially more than 30% of your income before the interest expense for interest expense. The idea is they want to prevent companies from borrowing way too much money and having too much interest and therefore wiping out all their income. Doesn't come into play until it's 27 million or more in income, okay, and gross receipts. Now that is before any expenses, so that's the revenue. So you get there a little faster, but still pretty good sized company there before you have to consider this. Okay, so that's C corporations. Other video on S corporations.